Income Tax 2020, Practice Problem 1, Presentation 46, Rental Property, Schedule E, Depreciation. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along. However, I do think they have a free 30-day trial. So if you get access to a promo or demo version of it or any other tax software, it could be a good tool to practice with. Continuing on with our comprehensive practice problem number 1, we're now focusing in on the rental property, adding into the mix the rental property on the Schedule E. So last time we set up our worksheet, which is basically going to be an income statement. We're going to get an income statement from the client. We might get a full set of books. We might just basically have the income statement. The Schedule E is in essence an income statement. I want to first now take a look at the depreciation, because if this is a continuing client, this is something that you'll already have kind of calculated in your system. In other words, you might not have it on your income statement because, of course, it is something that's going to need to be calculated within the tax software to calculate the tax depreciation typically, and therefore that's going to be one adjustment we will typically make. Oftentimes, it'll be in there already as well because we would have a continuing rental property and the depreciation or cost of the property would then be allocating over the life of the property. So we're going to add the depreciation. We're going to add it like this year, but just note, like in general, of course, you'd have the continuing depreciation, and you'd want to go to those depreciation schedules. And again, if it was a tax return that had been continuing from a prior year, had rental property last year, but it's the first time we entered it into our tax system, in other words, new client to us, but not new rental property, then it's probably a more complex return, and it would be worthwhile possibly to put the information first into 2019, match everything up, then roll it forward. If you have basically almost any kind of rental property, I think it's probably worthwhile to do that. But we're going to go ahead and enter this as of basically the first day of this year, so we can just put it on the books as of this point in time. So we're going to go to our depreciation schedule, and I'm going to call this rental property. Now, typically you'll have to be breaking out the rental property between the land and the building, because the building is going to be the component that will be depreciable. Now, again, this is only something you kind of have to really worry about when you first enter the information into the system, when they first acquire the rental property, and then once it's set up properly, hopefully it'll be good going forward and you'll be limited amount of work. But when you first set it up, that's going to be, something you got to put some time into and think about. So we're going to say that this is going to be rental property, and I'm going to say this is at 321. I'm just going to put the address, North Oakhurst Drive, we're going to say. And this is going to be, I'll say this is the land, and this is going to be going to Form E. So I'm looking for Form E here. So it's going to be a rental. And the activity, I don't have it set up yet, so I'm going to go ahead and leave that blank for now. Then the category is going to be, this is going to be the land component. So I'm going to say 6 land. Date, I'm just going to put it as of the beginning of this year so we can, make it easy that way. 01/01/20. So it wasn't there last year, but in practice, again, it would probably be something that's rolling over, but I don't want to enter the prior year depreciation schedule. So we'll just start it from this point. The cost or basis. Now, where would you break out the cost or basis? Because obviously if you bought rental property, then it would just be one lump sum. It's not like you're going to say, hey, I bought this much for the land and that much was for the building. You just pay whatever you pay for it. So if we pay $300,000 for it, whether it be loan or cash or whatever, we're not going to be breaking out between land and building. We just bought the entire thing. So sometimes the property tax statement will help you out with that, because the property taxes will typically have rates that will be based on the land versus the building. So you're going to have to come up with some kind of estimate. Sometimes the property tax statements are the first place to go. But in any case, I'm going to say it's $100,000 for the land. And we're going to say the method then is going to be the land. So I'm going to use 99, which is land or no depreciation. And that's going to be the land component. I'm going to add another one. And this is going to be basically the same. It's going to be 312 North Oakhurst Drive, but this is for the building. And then this is going to go to Form 3 again, the Schedule E. It's going to be now not category 6, but this time we're going to the building, category 4, also on the books as of 01/01/20, and I'm going to put this for 200,000. 200,000 building, 100,000 land. And this one, I believe residential rental is going to be Makers, and it's 27.5 years, I believe. So we're looking 27.5 residential renter property for the Makers, 27.5. Okay, so that looks good. So now if we pull this over, if I go to my forms up top, we then have our depreciation schedules down below. I'm going to go down below and say we have then our depreciation schedules being calculated. So I'm going to go down here, 2020. So there's the building and the land. I'm going to go to the regular one here. So the building and the land, same property. We're breaking out between building and land. The land is not being depreciated. The building's going to be using that 27.5 year, basically straight line method. But there's a mid-month convention that we're having. So they're going to. So it's imagining here that we purchased it basically in the middle of January. So if we do the calculation, it's got that slight little wrinkle in it. It's the 200,000 divided by the 27.5 years. That would be for a year, but we had only half a month for the first month. So if I subtract this 2 out, the difference between what we would think it would be and this, so minus the 6970 is 302. So that 302 is basically that half a month. So in other words, if I took the 200,000 divided by 12, that would be per year. I'm sorry, if I took the 200,000 divided by the 27.5, that would be per year. If I divide that by 12, that would be per month. And if I divide that by 2, that would be that half month. That half month is the difference. It's basically being reduced by there. So that's going to be our calculation for the amount of depreciation. This would then flow over to the Schedule E. So let's go ahead and set up a Schedule E now. I'm going to say we have the income, and we're going to set up a Schedule E. And the Schedule E is going to be, I'm going to call it residential property. And the address, I'm going to say, is the 321 North, let's say that's North Oakhurst Drive, and I'm going to say it's in Beverly Hills. I'm obviously just making this up, California, and then this is going to be 90210. And the type of property that we have, I'm going to say it's a single family residence. Number of days rented, I'm going to say 365. So we're not splitting it between the days and like vacation property. I'm going to say it's for the joint, since we're married, filing joint. I'm going to say joint. If required to file 1099s, did you or will you? I'm going to say, yeah, we filed the 1099s if we're required to file them. Non-passive activity, passive royalty, did not actively participate. I'm going to say that we did actively participate. Real estate professional, no. Rental other than real estate, I'm going to keep it as is. And so that's going to be our general information. If I then go back to the depreciation now, I can add that item. I'm going to go to all the depreciation up top. I'm going to add these items to the activity now of the residential property. So then we got that added to the residential property now. So that should then be enough to at least populate the Schedule E over here. So now we've got a Schedule E. And the thing I just want to point out is when you look at the Schedule E, if you're rolling it over from year to year, you'll already have this kind of popping up in the Schedule E. So when you do the data input, that could kind of mess you up because it's not going to be on this schedule. But it'll be in the return. And that's one of those types of things where the software is trying to help you, but if you have too many things that are popping up, it can be a little bit difficult to just tie in if you have a long Schedule E. So we'll practice just doing the data input next time, just inputting this into the system.